Bitcoin is up 200% since April 1st of this year, and most investors are being forced to chase this market higher if they miss buying the dip along the way. It's really tough to catch the bottom of the pullback with assets like Bitcoin that are super strong. Hi, I'm Doc Severson with Ready, Set, Crypto. In today's 1 minute market, I want to show you an approach that's been used by the most successful money managers in the world for decades and is just now becoming available for retail investors trading Bitcoin. When you see a market like Bitcoin rally like this, everyone says buy the dip. It's one thing to say it and yet another thing to successfully do it. Buying the pullback or the dip is emotionally difficult. You're trying to find that balance between not jumping on at the first red candle versus not being run over if the price migrates to an actual downtrend. Unfortunately, there's no all-clear bell that goes off when the bottom tick of a correction is printed. Normally, this is the point of maximum pessimism, that the former bull move is over and the bears might actually be right. Unless you have a trading system that objectively tells you where or when to enter on a pullback, or you're dedicated to dollar cost averaging, you will forever struggle with this tug of war in your head as you seek to buy the dip. But what if you didn't have to nail the exact bottom of the pullback to make money? Instead, what if you actually got paid by the market to buy Bitcoin on the pullback? Something that I've been excited about as we get into the back half of 2019 is to watch the same empowering trading methods that equity retail investors have been using for decades being applied to crypto. Or to put it a different way, I've been waiting for the crypto market to grow up. I've already talked about the power of futures contracts to create the perfect instrument for leveraged directional trades. And we're seeing new crypto futures vendors released literally every week to compete with BitMEX. But now we're starting to see some actual vendor solutions to leverage the advantages of options in the Bitcoin market. And this will only increase with institutional involvement. Now, at this point, you might be asking, options, what are those? Don't worry about the specifics for right now. Just know that if you've ever bought an insurance policy in your lifetime for your car or your home, or if you've ever bought a ticket to a sporting event, you've bought and sold options already. For those that have some experience with options, you might already know that there's two different types, puts and calls. I don't want to lose you out of the gate right away before I show you the power of these, so I'm not going to differentiate between them just yet. For this example, I'm just going to use a gender-neutral pronoun of option to describe the position and strategy, and we'll fill in the details and expand the nomenclature in subsequent videos. Now again, if you have any experience with options at all, you're probably used to hearing about an option as a leveraged stock substitute, such as Amazon stock costs $19.50 a share, so I'm going to buy an option for the next 3 months, which will allow me to control the gains of 100 shares, which would be $195,000 for a fraction of that price. That's the usual application that people learn about at first, which is as a leveraged stock substitute. Well, that's called a long option trade. And we can do the same thing with crypto. We can control the gains of 1 Bitcoin for a fraction of the price as a leveraged spot substitute. But here's a little secret. None of the professionals do it that way. The professional money managers turn this game inside out by running their trading like an insurance company. We like to sell a wasting asset, or the option, to someone else, and our goal is never to pay a claim, just like a real insurance company. We do it again and again and keep selling these wasting assets to someone else where they expire worthless on a repeated basis. We continue to harvest the premium on this regular basis and just crank the wheel every period. So how does this relate to our original, how do you buy the pullback problem? The current price of Bitcoin as I'm recording this is just over 13,000. It's breaking out of a consolidation pattern again, and you don't want to chase the price. You would rather pay 12,000 for your next entry on BTC instead of 13,000, right? So how about if we get paid for that pullback, even if the pullback never comes? Here's the option chain on Bitcoin for the US firm LedgerX, And we're looking at the 26 July options series. The 26 July $12,000 put option is 377 bid by 573 offer. You could actually be paid somewhere over $400 cash that goes right into your account today. You're offering to buy Bitcoin if the price was at or below the $12,000 level at expiration just over 2 weeks away. So there's three things that would happen between now and expiration. Scenario number one is that the price continues higher and your option will expire at expiration. It will release your obligation to buy BTC at the $12,000 price level, but you get to keep that $400 that you originally collected, and you're going to earn about 3.3% on your capital for the next 2 weeks. Not a bad return. Scenario number two comes up if the price comes down to about $12,000 on expiration at the 26th of July. You'll still keep the $400 that you got originally. But by this point, you can decide whether or not you want to take assignment of Bitcoin and buy it if you get assigned as the price goes below 12,000 by expiration, or you could just close the position for whatever it costs to close it down, but it should be well below that $400 cost to close it by this point due to the effects of time decay. So you can book your profit and move on to the next cycle. The third scenario, perhaps least desirable, is the price pulls back and actually goes below $12,000 by expiration on the 26th of July. You can still decide whether or not you want to accept assignment to buy Bitcoin as long as the option has not yet expired. If it's past expiration, you lose that option. So you can close down the position early for whatever the differential is between $12,000 and the current price of BTC below that level. Either way, you still have that original $400 credit to help offset that cost. So guys, this is how you can get paid for the pullback. Funds are using this strategy to earn income and lower their cost basis regardless of what the price does. Now, I should mention that if you run an insurance company like this, you must be obsessive about risk management if you want to remain in business. Being a deer in the headlights and not acting is no way to be a professional. So you must know at any given point when the trade is not working for you and you're better off stepping to the side. And this is why I will only play this strategy with an uptrending asset, not in the grip of a bear market. And guess what? The more you know, the better it gets. Once you have at least one BTC in assets, then you can rent out your Bitcoin and earn income from that as well. These are some of the simplest and most powerful option strategies that professionals use, which allows them to maximize their alternatives to earn regardless of what the market is doing. And as always with everything, there's a barrier to entry for some of the more advanced strategies. The barrier to entry very soon will no longer require that you be an accredited investor as it is now. The barrier to entry will be knowledge. Get paid for buying your next pullback. Let me know what you think about this in the comments below, and I'll see you in the next edition of 1 Minute Market here at Ready, Set, Crypto.